Welcome everyone. Welcome to this Market Thursday. It's October the 7th. It's 8 p.m. here in London. And as usual, a quick reminder that for the disclaimer, so this webinar is not is really for investment advice. So this is for information purely, and I do not take responsibility if you are incurring any losses. So please do your own research before doing anything. Quickly, my background, let's go into the next slide. Okay, so my background, I started in 2000, started in Paris working for an asset manager, working as an active trader, cash equity trader. Then in 2004, I came to London, worked for a hedge fund on the long only product and on the long short product. Then from 2009, 2018, prop trading for Infinity Capital Market. And in 2014, I did a bit of mentoring for another company. I stopped trading at the end of 2017. I was a bit tired. Did some mentoring in 2018 again, launched a 4x4 video series in 2019. And I restarted trading at the start of this year for Infinity Capital Market. So what are we going to be covering today? As usual, it's going to be the situation across asset classes. Looking at stocks, credit, commodities, FX. We're going to do a quick market review, looking at the Q3 end of the performance. Then we're going to be looking at the PMIs. The question mark is, do we reach the peak recently or over the last 3 months for the manufacturing and or the services? Then, as the earnings season will be kicking off next week, we'll be looking at the earnings season, and we're going to be looking at a theme that the market is looking at these days, which is stagflation, which is literally the talk of the day. So, as always, I like to start with what are the catalysts going forward. So tomorrow we get the NFP. The last number was pretty bad. We'll see. Yesterday we got the ADP number, which was pretty hawkish. So there is a lot of delta and possibility of let's say numbers missing between 200 to 500. So the trend is still NFP, the numbers getting better. We know that the Fed is looking at this number based on this dual mandate. Having said that, they said that they are not dependent on one data, and as the trend is getting better, they're going to be doing tapering probably from November onwards. As I said, we got the earnings season starting as always with JP Morgan. So JP Morgan will be releasing their earnings on Wednesday morning before the US Open. In terms of market, we had 2 to 3 weeks of active and higher volatility, first with the earnings expiry. The earnings expiry, the option expiry. Then we had the quarter end and the month end, where we had a lot of volatility, especially at the end of the month, because most mutual funds, hedge funds need to do some window dressing. So some sectors, some industry get hammered. And in terms of the overall positioning, as it happened just after the option expiry, we had a negative gamma overall for the market makers, which makes them selling a bit more when the market was going up. It was going down, sorry, and buying when it was going up, and this is why we had a bit more volatility. If you look at yesterday's move on the S&P, which was on Wednesday, we had 2 or 3 times a 40 points range. Between 48.80 and 43.20 due to those edging. So now we are in positive gamma, meaning that normally there is a small grind as it goes up. There are some rumors as well that the PBOC, which is for China, might do something in the near future. Why? Because there is tension on the credit market and commodities and inflation. Anything in China is a bit under pressure with Evergrande, the story that has been ongoing for the last 3 months, and something that we covered during the last webinar. So maybe expect something happening from China in terms of rates. Today, the Chinese stocks have been bouncing quite nicely. BABA is at 158 after being at 145. So there is overall stocks in China up 10% from the lows that we had a couple of days ago. So let's move into the next slide, which is the asset classes performances at the end of Q3 2021. So the picture is very much the same as it was before, which is emerging market struggling a bit more. If we look at Brazil, which is down on the year, having said that, India has been very strong. So picture is mixed for emerging, but overall, because of the weighting of China in emerging market, we are down 3%. Developed market have been doing pretty well. They are on average up 10%. S&P up 15%. Same story with Europe, with the stock 600. If we look at the currency, there has been a bit of acceleration of the strength of the dollar over the last month or so, which is something that I kept on saying from the start of the year, that the dollar, there was a good chance that the dollar will be strengthening. And that is what has been happening. Now we are trading around 115.50, 160 on the euro dollar. Bitcoin broke the 50,000. So for all the Bitcoin investors, that has been a good rally recently. On the other hand, gold has not been working so well, and it's down 7% on the year. And we get WTI up 54% and is now trading between 75 and 79. I think now it's at 78 roughly. Picture for at the end of Q3 year to date for the performances by sector. Energy is still very strong. Financial have been very strong as well, up 27% versus the S&P that is up 15%. For several reasons, obviously, for the steepening of the yield curve, yields going higher, which is helping financials quite a lot. You could see today, JP Morgan is at all-time high. KB, we're going to be looking at it later with the price action technical analysis that is trying to do some breakout. And in Europe, the European banks have been breaking out. So the names of Unicredito, BBVA, very strong, BNP, Barclays in the UK, Barclays making a nice breakout. So they are benefiting from better economies and obviously the yield curve steepening. On the other hand, you get utilities, consumer staples, the defensive, and as well the sectors that could suffer and are suffering when yields are going up, that are flat on the year. We can see that as well at the bottom, IT, anything that is Nasdaq tech has been doing more or less like the market. So what was interesting over the last 9 months is actually the tech stocks have not been outperforming the overall market, whereas before from 2016 to 2020 we had a huge outperformance from tech, and that goes hand in hand with yields going higher, where there is a bit of rotation and factoring where investors move from growth into value, even if value is not working that well. And Q3, looking at the industries, so we went from the indexes to the sectors. Now we are at the industry level. The top 20, interestingly, we get the retail, energy, obviously, anything that is bank, brokers, regional financial banks. So you can see that everything is above the 25%. And as well, industries that are quite cyclical and that are commodities related, that we know why there is a lot of inflation and investors are jumping and going for commodities. At the other end of the spectrum, the gold miners, the silver, anything that is gold has been struggling. Interestingly, the solar, the industry of solar, TAN is down 22%. There was a lot of hype last year based on the Trump administration, Biden administration, a lot of hopes around renewables that didn't work that well for the year. So next slide. Now we're looking at September 2021. So I wanted just to briefly talk about what happened in September last month. So if you haven't watched the webinar that we did at the end of August, I told you that there is very often a bad cyclicality or seasonality, should I say, in September. So for the month of September, the S&P was down 5%. And overall, most sectors or industries were down on the month, except energy and oil services and a bit of airlines. But overall, the month was a month of risk off, down 5%. That is only 5% as a drawdown. This is not the end of the world, but that is the first, let's say, more than 3% drawdown that we had for the year. Again, seasonality is something that works. You can be doing it. So quickly, I just want to mention UK gas prices. You can do the same for Asia, for Germany, for Spain, for the US. You know it. There is a lot of inflation pressure and a lot of speculation, even if I don't like the terms. There is a lot of buying pressure on UK gas prices everywhere in Europe, based on issue with hydro, not enough water, not enough wind, not enough gas coming from Russia. But that could create, as we discussed before, some tension on the European consumption, on operating margins for companies. Something that we discussed a bit in the community. I think, you know, when you have such a move, this is very often someone that is a forced buyer or forced seller. In that case, this is a forced buyer. I reached one of my ex-mentees who told me that actually there was a gas trader that was cut from its management, and they had to buy back his position at the start of the day. And this is why around the electricity curve, we had this massive jump, and we have been coming back. So we went this and down again. But still, prices year on year are massively up. We are talking 4 to 10 times across Europe. All the politicians are jumping. Always be careful with utilities, thinking that, oh, because the commodities are going up, utilities are going to be benefiting. As you see, and it's not only in Europe, it's the same in US, when the prices are going through the roof, politicians jump in. Why? Because everyone is paying utility bills, and this is one of the most important bills for the middle class. And that means for politicians, they need to jump and say, it doesn't matter if it moved by 50 and 100%. The utilities cannot reflect the prices, pass on the prices to the customers. So always keep that in mind, meaning that there is no necessarily unlimited upside for utilities to pass those prices. Seasonality, so I'm using this chart from topdowncharts.com, something that we mentioned as well before, where September we had a bit of seasonality down normally, and that seasonality, so like the warning that I'm giving you at the start of this webinar, that doesn't mean that it's going to happen again and you should be blindly going long the market. But from mid-October onwards, historically the market is doing pretty fine, and you know, the Christmas rally. So if you think about it, a couple of days ago, everyone was scratching his head and thinking, okay, when and by how much are we going to come down? And with the change of the price action, change the wording, meaning now investors will say, oh, I need to go long, I might go long the market. Make no mistake, it's all those moves that we have, like the one that we had over the last 3 or 4 days, happen very often just before the earnings season. If you look at the past earnings season, this is always the case. Before the earnings season, people readjust their portfolio, and this is pretty hard to go short the market when the earnings season so far, if you look at the last 4 or 5 seasons, have been that good. So let's jump now into the price action technical analysis. Where are we? Okay. So let's jump into the VIX. So the VIX, I always start with it because, you know, as a trader, I'm always thinking, where is my implied volatility? So implied volatility is now coming back to its, let's say, all-time average, which is around 19%, 19.3%. So we're coming back after actually a prolonged period of implied volatility above 20%. So implied volatility was pretty high recently, and that tells you as well about, you know, if the sellers of volatility are coming back again, that this market has even more chance of going higher, because, you know, volatility, what they do is they will be selling the volatility, and the underlying will be going higher. Let's go and look at the S&P futures. So S&P futures, so that's the chart. So the trend that started in November, as we discussed 2 weeks ago, has been broken. Okay, so the trend is broken now. As always, the question is, do we go, which is very rarely the case. You're gonna have, after such a strong rally, some consolidation. Feels like we are potentially moving into a new trading range so far. That is this range between this 4250 and this 4500. So you got roughly 250 points. What was interesting is actually over the last 3 or 4 days, the S&P futures didn't make new lows. Okay, so there was a lot of noise of, you know, this is the end of the world and we are close to the end of the world. But actually, if you look at the day after day, at the start of this week, we were not making new lows, which is very often a big positive. So that's for the S&P, and the price, the recent price action. If you do a similar picture with the Nasdaq Composite, so we touched 4 days ago. That was on Monday, and because, you know, with technical analysis everything could change quickly, but a first support, everything. So we bounced around this 14,200, and since then we have been rallying based on the debt limit and all the noise from politics in the US. But so far we have been consolidating. We are not going into those important support. If you do the same now with the Russell is not giving you any indication. The trading range is still the same between 2130 and 2360. Quickly for Europe, for those of you who are watching tonight or watching on YouTube later, the picture is more or less the same as the S&P, which is we have this massive trend from November going up. Then we broke it, and now we are consolidating, trying to find out what's going to be the next move. If I go back, sorry, very quickly into the S&P, and I give you a monthly chart. What was interesting for last month is really the candle was obviously pretty disgusting. Okay, so when you have such a bad candle for the month of September, very often it's hard to take the highs very quickly. So check the 4,500 as potentially a strong resistance, 45 to 50 to 4,500. Because technically, if you look monthly and quarterly, it doesn't look great. What else do I want to check here? I wanted to check with you the financial sector. So let's go back into a daily chart, and we're going to be doing this. Okay, so trying to make to do a breakout. So far, there is no real breakout, no follow-up. Why? Because we are all waiting for those catalysts, which are from next Wednesday, JP Morgan, then on Thursday we get Bank of America, Wells Fargo, then we get Morgan Stanley, we get Goldman Sachs. But literally the XLF is close to breaking out. If we look at KBE, which stands for the ETF bank, very similar picture. We are close to important levels. So for those of you who like cup and handle, we're getting closer and closer. SOX, Philadelphia, semiconductor picture is still the same. Why? I'm sorry to always repeat myself, not only because I'm a bit old, but we know that semiconductors were the drivers, the leaders of this market, and we are now struggling to find new leaders. You can see the consolidation of the Philadelphia semiconductor. This is one to watch. If it breaks up and down, I think that will tell quite a lot about the market overall. Some chart that I was checking just before the call, looking at Ford, an interesting one today, above average volume, some breakout. So something to carry on check for the following sessions. Other one, APD. I know that some of you have been invested in that one. Why? Because I think it reached an important support level around the 255. Now it has been bouncing. So for those of you who have exposure to the sector, APD is obviously one of the market leaders. And as long as we are holding above the 255, I think the price action for the industrials and for this sector is going to be pretty much okay. The trend has been for the last 2 to 3 months, downgrade of earnings, supply chain issue, bottlenecks, you name them. And so if you do a bit of here, this is the trend that we have been having for most of those stocks for the last three months. Finally, on the stock, just BABA, because BABA is bouncing nicely today at 155 now. It was at 158 a bit before. So there is a big bounce. Most Chinese stocks have been bouncing. As I said, there are rumors that the PBOC, sorry, will be intervening soon. Plus let's say the market perception was so bearish on China that it's not unusual to see such a bounce. Having said that, as I said, when it was at 160, or when it was at 170, or when it was at 220, the trend is still the same. The trend is still down, and as long as we have not been closing above this downtrend, we are in a bear market. But that is quite something to see such high volatility on a name like BABA. Still very strong moves over the last 2 to 3 months. Finally, just a bit with euro dollar. So euro dollar picture is the same. I think there is a good chance it's going to be testing the 112, 113. People were saying at 120 no, at 119 no, at 118, 117, 116. So that's the trend is still your friend there. It's working very well on that stock on that pair. Sorry. Okay, let's go back into the slides and discuss manufacturing PMIs. So the Purchasing Manager Index, here this is for the world. So you get the US in gray, China in yellow, the Eurozone in blue, Japan in green, global, the world in purple, and in red, this is for emerging markets. So as you can see here, it has been toppish, to say the least, for Eurozone and the US, which are making 40% of the world GDP. We have reached a peak over the last 3 months. So we knew that the V-shaped recovery, which is this one, like the market, has made an overextension on the way up. So now it makes sense that those numbers are now cooling down a bit. Still, the question mark, if you've been keeping on looking at those data, is are we going to be around the 54, 55, 56% for the global, which is in purple here, or are we going to go back into what we had before, which is probably around the 52%? And that makes a big difference, because that makes obviously the world growing at 2 to 3% instead of 3 to 5%. So this is for the manufacturing PMI, the world here. So this is the source is obviously market. You can go on their website. They give you every month details by country, and it's quite helpful to understand, you know, what are the momentum, what are the different countries doing. As they have been saying, the global manufacturing PMI's upturn has been constrained by supply chain disruption and input shortages. So in other words, that means that the world is not running at full capacity. Why? Because there are bottlenecks everywhere, because it takes a long time to ship things from one place to another. It costs a ton to send things from China to Europe. All the factories are not working. All the lorry drivers are not available. So in other words, I think it gives probably another 3 to 9 months of growth, because we could not reopen the world as quickly as we wanted, in other words. But I think for growth, that means we probably gonna have another 6 months of growth in the as the underlying. But the concern has been on the left-hand side. So here you get the ISM manufacturing for the US. This is all about inflation. So if you've been following the market and not even following the market, you know that inflation is the problem that the world is facing. So we had the transitory inflation set by the central banks, which is, you know, commodities going up. But now the issue and the problem is probably if we get a second wave of inflation based on wages going higher, based on still supply chain issues. And as we can see here, the prices are still very high. So we are at 80% plus for the ISM manufacturing. We are at 75% plus for the ISM services. So very high prices, which are running way above the 2% from the Fed, or the 2% target from the ECB. So we are probably running around 4 to 5% for the core PC, which is way too high. And if it doesn't come quickly, that's going to have impact for operating margins, as we discussed before. Companies will be struggling to pass on prices to customers. So you can do it to a certain extent when you are a price maker, but at one stage the customer will say no. The good thing about the ISM manufacturing and the services is the new orders are still very high. So that tells you that the activity is pretty strong. So don't be that bearish about the cycle, at least for the next 1 to 3 months. Picture is still okay. Looking at the comments, that's the same. Go on the ISM.org and looking at what have been the recent comments about the supply chain. So as we can see, there's a lack of labor and escalating cost, delaying order deliveries, supply chain concerns, shortage of shipping containers, global supply chain constraints. So really the whole supply chain has been facing huge hurdles and huge problems, and it's still ongoing. China is partly closed because of COVID. A lot of Asia is partly closed, which is creating tension across the supply chain. So that means again we have above average inflation, and we are not running at full capacity. But in the other hand, that means as well that the central banks need to be more active and they need to fight inflation. So if you remember 3 or 6 months ago, they were saying no, inflation is transitory. It's going to be reverting to the mean pretty quickly in the next 3 to 6 months, and 6 months after, we are still in the middle of the storm. So inflation, as it is running above this 2%, unfortunately, central bankers will have to do something on that front. Services, as I said before, so this is for the US, picture is still pretty good. So the services, we had a bit of a hiccup in August in the US with the COVID variant, where the economy closed a bit. And with the back to school season, there was a bit of uncertainty. Now I think the US are back on track, as long as we can quickly solve this issue of the supply chain and shipping things from one place to another. Earnings season. So every 3 months, you're very lucky. We are doing the earnings season, and why we want to do so, because if you've done the 4x4, you know that there is a strong correlation between the level of the S&P market and the earnings. So in the long run, as long as earnings are growing, normally the S&P is going up, unless you're going to have a PE compression, which actually you might see a bit of PE compression in the next few months. Why? Because yields are going up. But let's look at the earnings season. And here you can be using FactSet. So you can go on factset.com. They get some nice weekly paper coming every Friday. I like them very much. So for the Q3 year-on-year earnings, they are expected to be up 29%. So not bad, excluding the energy sector. We will be up 22.6%. So obviously, based on commodities and energy up massively year on year, the energy sector will benefit massively and will be a huge contributor to the year-on-year earnings. A bit of data here. Out of the 17 companies that have already reported, 82.4% have reported earnings above analyst estimate. Why it does matter? Because historically the beat are around 65%, but over the last 4 quarters we had a beat around 85%. So the beats from earnings from US companies over the last year have been just insane. Okay, so each time we started a quarter, we say, oh, actually the expectations are pretty high. It's going to be hard to beat. And 85 to 90% of the companies were beating expectations. So it really, really matters to see what are the expectations and by how much companies can be beating those expectations. So as always, looking at the 11 sectors of the S&P, what are the expectations, what is and how they are expected to grow. As we can see, energy is literally the big contributor and the big winner. So we went from earnings negative by $1 here in last year, positive to $20 for this Q3 now. So big move. Real estate, but interestingly, you can see that IT, so technology, is going to be doing the same as the S&P. So what was characteristic of 2020 is the IT sector kept on beating and kept on beating expectation and as well having much higher earnings growth than the S&P 500. Whereas these days, it's more or less like the S&P. And that goes hand in hand with the sector performance year on year, which, if you remember, S&P is up 15% and the Nasdaq is up 13 to 15%. So more or less the same. Anything that is cyclical and reopening of the economy, like materials and industrials, are expected to be up by around 80% plus. So big numbers. And that tells you obviously of the V shape of the economy and why those numbers are going up so much. Interestingly, what has been the trend over the last few months of the S&P expectations? Normally, over the last few quarters, you will have seen a chart like this one. It will have or even more like going up and up. Over the last 3 months, what was interesting for this market is the market participants and the analysts downgraded a bit their expectations. So we were coming from high expectations to lower expectations. So we went from $415 to $413. That is not that big, but that tells you that the earnings momentum or the earnings upgrade are not as strong as they used to be. And again, very often, if you want a market to be strong, if you want the S&P to go higher, it goes in tandem with earnings revision up. So if we go into the next slide, I try to do a bit of dodgy correlation here, but you're going to have the picture. So here in blue, this is the downgrades and sorry, the upgrades, and in gray, the downgrades. So as you can see, the numbers from the revision have been coming down. And in the meantime, the S&P has been struggling to go much higher. So always, you know, the market is pretty, how do you say that, pragmatic, that if you get earnings growth and earnings are expected to be even higher from 1 month to another, what you're going to see is the market going higher. If you do the same with stocks, and actually this is something these days that we do during the mentoring sessions, is we're going to be looking at what have been the earnings upgrades and downgrades over the last month for any single stock. So if you got Reuters Icon, if you got other software, what you could do is you'll be looking at what are my expectations now for 2020-21, whereas, you know, we only got 2 quarters left, versus a month ago, and you see if there is upgrades and downgrades. And you can do the same for 2020-2022, whereas, you know, if there is upgrades and downgrades. And as you're going to see, very often there is a strong correlation between the price action of the stock and if there have been upgrades and downgrades. So question, this is a slide that I used during the last webinar, is have we experienced a top in the earnings revision? So we had a massive, from the bottom of the market, a massive upgrade revision. And since then, at least over the last couple of months, we had a bit of topish situation. And this is why the market, the S&P, the Nasdaq are a bit topish. To have another leg on the way up, you need either the P to go from 22, 23 times to 25, 26 times, or earnings growth. For the P extension, I think it's going to be a bit difficult based on the Fed and the central banks being more hawkish and yields going higher. And on the earnings, we'll see. Again, I don't have the answer yet because the earnings season is starting next week. But based on so far, we had 4 crazy quarters. It's going to be pretty hard to beat by 85%. But, you know, with the US companies, you never know. So as we are in the earnings season or close to starting the earnings season, here I'm using what's that? The markets earnings whisper. But you're going to have several websites. So try to know when companies are coming with their earnings, when are each sector's leaders, industry leaders, or companies that are competitors from one position that you have. So let's say you got a position in, if we take the example here, if you got a position in Wells Fargo or Bank of America, you would like to know on the day before how JP Morgan has been doing. If you get a position in JETS, which is the ETF for the airlines, you'll be looking at obviously at the first company that is coming with their earnings, which is Delta Airlines. So the next month is going to be pretty busy. Most of the companies will be releasing their earnings in the next months. So make sure that you know when and for each single day they will be coming. A bit of macro, a bit of stagflation. So I took the definition at Google just to make sure that we were on the same page. So what is stagflation? So stagflation is a persistent high inflation combined with high unemployment and stagnant demand in a country's economy. And why I'm looking at it? Because these days everyone has been looking at it. Okay, so the last 3 weeks, everyone is talking about stagflation. So on Twitter, even on Google, so there's a lot of talk of high inflation and pretty rubbish growth. Okay, so inflation, we know that there is a lot of inflation in the system these days. And if you look at the stagflation, very often macro guys will tell you, oh, okay, you need to be looking at something like 30, 50 years ago. So let's look at what happened 50 years ago or in the 70s. So 70s, at the start of the 70s, I was not born, but you see here so this is the chart of the CPI on the left-hand side, which is for the consumer purchasing index, which is for the inflation in the US versus the GDP growth, the US GDP growth on the right-hand side. And what is interesting is obviously because of the oil shock that we had in 1973 and 1974, 1975, inflation went massively up. And in the meantime, there was no growth, and it literally destroyed growth in the US and growth in the world. So that was a proper shock. Okay, question now is, what kind of inflation do we have? So if we look at the CPI that we have here, we are talking 12% year on year. Okay, 12%. And in the meantime, growth could be averaging, between 6 and 10% in the US. So we had much higher inflation, much higher growth. So what do we have these days? So these days, and here I'm using the Wells Fargo Securities page, which I find pretty helpful, which gives us, the several indicators about supply, which gives you about inflation. So here we got the ISM that we discussed before. We get how the shipping have been doing. We got the prices, we got inventories, we got labor. And as we can see, from let's say March onwards, this is trouble. Okay, this is trouble for the supply chain, this is trouble for inflation, this is trouble for everything. So what we discussed 6 months ago, where we asked the question, is it transitory? When it's staying there for more than 6 months, it is not transitory anymore. So really, inflation is there. Inflation is running at 4 to 5% in the US and in Europe. So are we in a stagflation situation? Obviously, when you get inflation, normally central banks need to do something. So if you look at the correlation between the core CPI and the Fed fund target, so here I'm using a chart that I'm sharing in the 4x4 video series, is you see normally the Fed fund target should be much higher. So instead of everything being at 0%, we should be probably at least 2 to 3%. So here, clearly, if inflation stays here for too long, something has to give. Unless you see inflation coming back rapidly, central banks need to act pretty quickly, because otherwise you're going to have the second wave of inflation, and then you are in big trouble. So here I'm using some data that I found with Barclays, which I found pretty helpful, and I shared in the community, which is how the different sectors have been doing when there is a bit of inflation, stagflation. And this is as well looking at the different performance of the sectors depending where is the ISM. So we know that the ISM is above 50, but is a bit falling. It's not very clear, that probably it's peaking. And US CPI here is above year-on-year 3%. So in that case, what are the sectors that are doing fine? So you get the telcos, utilities, which is obvious, which is not that obvious actually, because you could argue that yields are going up. So this is for telcos not necessarily, and utilities not necessarily the base case. But if you look here similarly for the European sectors, you can see that ISM falling but staying above 50, and US CPI year-on-year rising, that the banks are doing fine. So something that I mentioned at the start of this call, when we look at the price action, the banks have been doing very well. If you look at the chart of the European banks, there have been some breakout, as I said. Same for the US, they are benefiting from higher inflation and the steepening of the yield curve. But spend a bit of time, maybe if you're watching later on YouTube, pause on this and look at the performance of the several sectors depending on the different scenario. I find this pretty helpful. We know that the trade so far has been long commodities, and everyone on Twitter is telling us that they have been long commodities and making the ton. In reality, investors are still pretty much underweight commodities and energy. So there is, if really we get more inflation, there is a case for another leg up in the rally. And this is why you have people pushing for oil going at 100 and above. That doesn't mean that prices of like gas will not go down, but overall commodities could go higher based on this on the weight. Another, oops, sorry, let's go there. There is a good, very good report from the best strategies for, so this is here for inflationary times on the SSRN website. Strongly advise to you to look at it. I took some tables from them, which I found very interesting about how the different, here this is the factors, how if you were investing in value, if you are investing in momentum, which strategies were working the best. When we had the 70s, in the 70s, inflation, stagflation, the momentum strategy was the one that worked the best. Okay, and you can see really by how much the strategy has been working well. Now, the next question that you're going to be asking, and I asked the same, which is, what is exactly momentum? Momentum is like, I buy what is going up and sell what is going down. So momentum is not a clear definition, but you see as well that value did pretty well. So this is what happened in the 70s. If you look into the next slide, we're going to have some of them. So this is the 40, 60 equities, bonds, looking at the performance over time. Again, pause here, have a look at those tables. Otherwise, even better, look at the paper. This is a 30 pages paper. The conclusions are pretty obvious, which is commodities, when you get inflation, are doing pretty well. Having said that, what I found interesting is the different styles and if we go into that slide, which are the sectors, okay, the 11 sectors of the S&P. So the weak sectors are the one with high exposure to individual consumer, such as durables and retail. So you can see that durables, durables here are really struggling when there is inflation. Retail as well is struggling. On the other hand, you get the health that is doing very well in a situation like this, and energy. And actually, what was interesting here is financials here are not outperforming and are doing as badly as some other sectors. Why? Because they can be a lag between inflation and the central bank's tightening. So XLF financials making new highs, but history tells you that there could be some consolidation going forward. I'm just checking the market quickly. 4,400 on the S&P. Not a great close, actually. Where can I help you if you want my help? So the trading community, pushing for it. We get new players now. We get new people joining every week, so that's a good thing. So we get daily comments that I try to put, people from Australia as well, from Asia, jumping, and we get different themes. We get the trading places where it's for the day. We get the general discussions, we get the macro picture, ideas for the long, for the short, how to deal with your risk management, how to help you with your infrastructure, and everything that is a pub, which is football, and you name it. Second part where I can help you is the 4x4 video series. So based on my 20 years experience on long only, long short, prop trading, long short, a bit of everything, and working as a mentor for another company and knowing what people were missing or what people were really struggling with, I created the 4x4 video series where you can have access to 30 hours plus of videos, 50 Excel spreadsheet or plus. I know that some of you have been struggling with other education. I know where you've been struggling. Because there is no infrastructure, you don't know what to do, you are missing the investment process. I can tell you that people that have been doing the 4x4 have been very happy about the product. Finally, the mentoring, so one-on-one session, something that I really enjoy doing. I really enjoy doing and looking at my mentees and helping them and seeing them growing. So this is a really good thing. I really enjoy. So in terms of Q4, no places are going to be limited because there has been a strong demand recently. But if you get question or if you want to do the mentoring, reach me, send me an email, and we can have a Zoom call to discuss that. This is it for today. Any question? Almost the market is almost ready to close in 5 minutes. 4,400 feels like there is so NFP tomorrow before the open. Market has been bouncing nicely, back 2 to 3%. Let's see how the earnings season will be. Keep an eye on the earnings season. I think this is the real driver. There is a lot of noise around the debt ceiling, Evergrande, gas, everything. But actually the market has been digesting information pretty well. But I think in terms of technical, after this massive move up, now we are consolidating. It's going to be hard, I think, to be making new highs quickly. But let's see how it goes. And finally, just on the implied volatility and the hedging, because I know that some of you are doing options. Always, when you look at options, educators are not talking enough about this. When you're buying options, you're buying premium, and when you're buying premium, you're buying a level of implied volatility. So I know many people come to me and say, look, I've been doing another education, and I've been absolutely hammered because I've been destroyed on the implied volatility when the implied volatility goes down. So if you've been buying protection when implied vol is at 25%, you are suffering when the market is flattish with the theta and implied vol going down from 25 to 17, 18%. Thank you very much. I'll do another one in a couple of weeks. I'll put everything on YouTube tomorrow. If you get questions, you can reach me. And thank you for joining, and see you soon. Have a good earnings season. Bye-bye.